Welcome to the deep dive. Today, we're really plunging into a story that sits right at the absolute heart of this AI revolution. We've all heard about the incredible, almost, insatiable demand for raw computing power that's driving so much innovation, right? But what company is actually sort of quietly making that possible for the biggest names in AI? We're going to uncover the story of CoreWeave. It's a name that's rapidly grown into a multi-billion-dollar entity, often, well, without much fanfare.
That's precisely it. CoreWeave calls itself a specialized AI hyperscaler, and honestly, their rise has been truly astonishing. For this deep dive, we've really dug into their business model, their technology, the financials, and the competitive landscape they're operating in. Our goal here is to pull out the most important insights, giving you a crystal clear understanding of this, well, really critical player.
Okay, so our mission today is to truly unpack CoreWeave's explosive growth. We want to understand what makes them unique in such a crowded space, and also shine a light on the, let's face it, substantial risks that come with such an aggressive expansion strategy. By the end of this, you'll be incredibly well informed on this crucial enabler of the whole AI world. So let's get started.
What's truly fascinating, I think, is that CoreWeave's origins are surprisingly far from the typical Silicon Valley tech startup story. It
Yeah.
was founded back in 2017, not by engineers or computer scientists, as you might expect, but by three commodity traders, Michael Intrater, Brian Venturo, and Brandon McBee. They came from a hedge fund, Hudson Ridge Asset Management. And this non-traditional background, their experience in volatile markets, it really shaped what they call their asset-first mentality.
An asset-first mentality for a tech company. It's definitely not the usual playbook. So they started as Atlantic Crypto, right? Focused entirely on Ethereum mining, which of course meant getting their hands on a massive fleet of high-end GPUs. I heard they even started out of Venturo's grandfather's garage in New Jersey. Quite the humble beginnings for what they've become.
Indeed. But then came what they've actually described as an existential crisis that was during the 2018-2019 crypto market crash. Suddenly, they're sitting on this huge inventory of GPUs, and their utility for mining was just plummeting. Now, instead of just selling off these assets, which many probably would have done, they recognized the intrinsic value of these powerful GPUs for other things, other compute-intensive tasks like 3D modeling, scientific simulation, data analytics. And this pivot, it was incredibly successful. Their cloud division grew by an astounding 271% in just its first 3 months after that shift.
Wow. The timing here seems almost, well, too perfect, doesn't it? They officially rebranded to CoreWeave in October 2021. Then, late 2022, ChatGPT just explodes onto the scene, unleashing this unprecedented global demand for GPU compute. Legacy cloud providers, the big guys, they just couldn't keep up. And CoreWeave was perfectly positioned. Was it pure foresight, do you think, or more a case of being uniquely prepared when that wave hit?
It was certainly a, let's say, fortuitous alignment of preparation and opportunity. They had spent years really perfecting their operations around these exact machines, understanding their capabilities inside and out. And this brings us back to their financial innovation, which is a direct legacy of those commodity trading routes. They viewed GPUs not just as depreciating hardware, but as, well, financeable revenue-generating assets. Much like commodities, actually. They pioneered using NVIDIA GPUs as collateral for multi-billion-dollar debt facilities. That's a truly revolutionary asset-backed lending strategy in cloud computing. And that allowed them to scale at just an unprecedented velocity, solving the huge capital bottleneck that usually plagues these hardware-intensive businesses.
That really does sound like a game changer. So, okay, they've got this financial wizardry down, but what about the actual CoreWeave cloud platform itself? Their central claim is that it's purpose-built for AI. What does that mean in practice, and how does it fundamentally differ from what you get from, say, AWS or Azure?
Right. It means they've engineered their entire platform from the ground up, specifically for these large-scale AI and high-performance computing, or HPC, workloads. Imagine it like a dedicated express lane just for your AI tasks. They use what's called a bare metal approach. In simpler terms, this means your AI models get direct, unmediated access to the physical hardware. They bypass the usual virtualization layers. Think of it like a software middleman that can introduce latency and reduce efficiency on general-purpose clouds. This direct access really maximizes the GPU's computational power. They also offer a really comprehensive range of NVIDIA GPUs, everything from earlier generations like the A100 and V100, all the way up to massive deployments of the cutting-edge H100 and H200. And very notably, they were the first to make NVIDIA's super powerful Blackwell architecture, including the GB200 NVL72, generally available. This kind of early access, well, it's a huge draw for premier customers like OpenAI, Mistral AI, and IBM.
Okay, so it's not just about having the latest chips, but also how they're all connected. That's where this network fabric, InfiniBand, comes in, right? How critical is that for large-scale AI training, and what makes it so special?
Oh, it's absolutely vital. Think of it as a super fast, dedicated highway for data moving between all those GPUs. For large-scale AI training, you need ultra-low latency and massive bandwidth. Their non-blocking one-to-one InfiniBand topology is key here, because it allows tens of thousands of GPUs to function seamlessly, pretty much as a single supercomputer. This delivers incredible bidirectional throughput. We're talking up to 3,200 gigabits per second per 8 GPU node. It ensures data moves between chips almost instantly. They also leverage NVIDIA BlueField 3 data processing units, or DPUs. Think of DPUs like a highly specialized support team. While your main AI chips are crunching the really complex numbers, these DPUs handle all the background stuff, networking, storing data, security, keeping the main chips free to focus purely on the AI work.
Got it. And to house all this cutting-edge hardware, they must need some incredibly robust infrastructure. Tell us about their data centers. What's the scale there?
Well, CoreWeave is on an incredibly aggressive global expansion path. They're aiming to operate over 33 state-of-the-art data centers by 2025. That's housing over 250,000 high-performance GPUs. And to power all this, they've secured 1.6 gigawatts of contracted power capacity, huge numbers. These facilities are designed for ultra-high rack power densities, up to 130 kilowatts per rack, which is essential for these increasingly power-hungry AI machines. And what's particularly forward-looking is their commitment from 2025 onwards. All their new data centers will incorporate liquid cooling. That's crucial for next-gen hardware like the GB200 NVL72, because honestly, air cooling just won't cut it anymore. Strategic partnerships like the one they have with Digital Realty are helping them accelerate these deployments, allowing them to stand up new capacity in as little as 18 months sometimes.
So they've nailed the hardware, the networking, the specialized data centers, but what about the software layer? How are they moving beyond just raw compute and, as you said, up the value stack?
Right. Their core software platform is built on something called Kubernetes, which essentially helps them manage and orchestrate these huge clusters of machines really efficiently, and it runs directly on their bare metal servers. They also provide managed services like specialized scheduling tools tailored for AI workflows and proprietary tools like Mission Control. Mission Control helps ensure incredibly high cluster reliability. In fact, they achieve what they call good put. That's the percentage of time the computer is actually doing useful work for you, at up to 96%, which is a seriously impressive figure in this field. But maybe the most significant move up the value stack recently was their acquisition of Weights and Biases. That was for $1.7 billion back in March 2025. This wasn't just another company buy. It's a really critical strategic pivot for them. It shifts CoreWeave from being purely an infrastructure as a service, or AAS provider, towards building a robust software-based competitive moat. It integrates them directly into the AI development lifecycle, offering an integrated developer experience that frankly will be far more difficult for competitors to just replicate.
That makes a lot of sense. Moving beyond just, renting out hardware and into the actual developer workflow. Okay, now for the real numbers. Their architectural claims sound compelling, but how do they actually translate into measurable performance advantages for their clients? Because beyond the theory, you need to see the proof, right? What do benchmarks tell us?
Absolutely. And their performance claims are substantiated by rigorous industry-standard benchmarks. This directly translates into faster model training times and, importantly, greater cost efficiency for clients. MLPerf is a key one here. You can think of it as a sort of Olympics for AI performance.
Okay, let's unpack their MLPerf highlights then. What particularly stands out to you from those results?
Well, in MLPerf training version 5.0, CoreWeave, working with NVIDIA and IBM, deployed the largest ever NVIDIA Blackwell GPU cluster submitted for public benchmarking. That was 2,496 GPUs. They trained the Llama 3.1 405B parameter model in just 27.3 minutes. Now, to put that in perspective, that's more than twice as fast as similarly sized clusters using the previous generation NVIDIA Hopper architecture. A huge jump. Then, in MLPerf Inference version 5.0, CoreWeave was the first cloud provider to submit results for the NVIDIA GB200. They achieved over 800 tokens per second on that same Llama 3.1 405B model. This represents a remarkable 2.86 times per chip performance increase over the prior NVIDIA H200 GPU. It's a genuine leap forward. That is a significant leap. And then there's this metric, model FLOPS utilization, or MFU. Can you explain what that is in simple terms and why it's such an important measure for AI training efficiency? Sure. MFU is essentially a measure of how efficiently you're using the hardware. It defines the percentage of a system's theoretical peak processing power, its floating point operations per second, or FLOPS, that is actually applied to the model training cask itself. So a higher MFU means less wasted computational power, maximizing the return on investment for those very expensive GPUs. CoreWeave's purpose-built stack, because it minimizes those inefficiencies we talked about, achieves MFU exceeding 50% on NVIDIA Hopper GPUs. Now that's up to 20% higher than the 35% to 45% MFU typically seen from other providers. That's a substantial difference in practice.
Okay, so their architecture genuinely squeezes out more usable performance from the same hardware. Can you give us a couple of quick MFU comparisons with other providers just to really drive that point home?
Certainly. For a 30 billion parameter model, CoreWeave achieved 51.9% MFU compared to 40.43% reported by Aleph Alpha. That's a 28% increase in efficiency using the same kind of hardware. And on another comparison, with the same hardware and model size, CoreWeave hit 49.2% MFU versus 41.85% from Mosaic ML. That's an 18% improvement there.
Those are definitely not marginal improvements, not by any stretch. So what's the tangible, real-world impact for their customers when they see these kinds of numbers? What does it mean for them?
Well, the real-world impact is really a step change in productivity and, crucially, speed to market. For a major player like Mistral AI, it translated into a 2.5 times acceleration in their model training speeds. That's huge. For IBM, it unlocked up to an 80% performance boost for their AI workloads. These numbers really underscore that CoreWeave isn't just offering compute. They're offering highly optimized, incredibly efficient compute that directly benefits the customer's bottom line and drastically cuts down the time it takes to develop and refine their AI models.
All right, let's switch gears and talk about the money, because CoreWeave's financial story seems just as dramatic as its tech story. Tell us about their revenue trajectory. It's truly astonishing, isn't it?
Astonishing is the right word. Their revenue growth has been nothing short of meteoric. I mean, look at this. From $15.8 million in 2022 to $1.92 billion in 2024. That's a staggering 700% plus increase in just that final year. And the acceleration continues. They reported $1.21 billion in revenue in Q2 2025 alone. That's a threefold increase year over year. And they've already raised their full year 2025 guidance to between $5.15 billion and $5.35 billion. It's just a parabolic curve.
Those numbers are immense. But with that kind of hypergrowth, there must be some significant risks involved. I've heard customer concentration is a big one for them. Just how narrow is their customer base?
This is definitely a point of concern. It's a perilously narrow customer base, and it's acknowledged as a primary risk factor in their financials. In 2024, Microsoft alone accounted for 62% of their revenue, and that figure actually climbed to approximately 72% in Q1 2025, the top two customers combined. They contributed 77% of revenue in 2024. This creates a huge systemic vulnerability, especially given that Microsoft's demand is largely driven by OpenAI. So if either of those key partners were to significantly reduce their spending, maybe build out more of their own capacity faster than expected, it could have a really devastating impact on CoreWeave.
Okay, so they're growing incredibly fast, but relying very heavily on just a few big players. How are they funding all this massive expansion then, particularly with that unique debt strategy you mentioned earlier?
Well, they've raised a significant amount of equity, over $2.37 billion, from major investors like Magnetar, Fidelity, Code2, and even NVIDIA itself, which is interesting. But the truly distinctive part, and frankly the much larger part of their funding strategy, is debt. Over $11.1 billion in debt financing. They pioneered using those NVIDIA GPUs as collateral for multi-billion-dollar debt facilities, like that $2.3 billion facility they secured back in August 2023. This approach allows them to avoid severely diluting the equity of their founders and early investors, which is clever. But of course, it comes with significant interest costs and obligations.
Speaking of cost, are they actually profitable yet with all this incredible revenue pouring in?
On a GAAP basis, that's generally accepted accounting principles, no, they are not yet profitable. They reported net losses of $863.4 million in 2024, $593.7 million in 2023, and $290.5 million in just Q2 of 2025 alone. A major factor driving these losses is their massive interest payments on all that debt. It amounted to $267 million in just Q2 2025. And some of their debt, like $2 billion in unsecured notes they issued, carries a notably high interest rate of 9.25%. That adds up fast.
So very high growth, but also very high debt and substantial losses. What's the central pillar then of their financial architecture that allows them to keep raising all this capital and reassure lenders? What keeps the cycle going?
That would absolutely be their revenue backlog. As of June 30, 2025, it stands at an impressive $30.1 billion. This figure represents committed future revenue from long-term customer contracts they've already signed. For lenders, this backlog provides crucial visibility and, well, security. It demonstrates a guaranteed stream of income down the line to service the debt. It creates this powerful, self-reinforcing growth cycle. Large, long-term contracts drive the backlog, which in turn secures more debt financing, which then allows them to procure more cutting-edge hardware to fulfill those contracts, and so on. It's a virtuous cycle for growth, provided, of course, those commitments hold and the market continues to boom.
The numbers are absolutely staggering, and that $30 billion backlog is clearly crucial. Now let's talk about their relationship with NVIDIA. It seems like such a deeply symbiotic relationship. But is it a strategic moat that secures their position, or could it potentially become a kind of gilded cage that limits their future options?
It's truly both, I think. The benefits are immense and just undeniable. CoreWeave consistently gets priority access to NVIDIA's latest and most powerful architectures, H100, H200, now Blackwell at scale, and crucially, often before almost anyone else. In a market starved for these chips, that's an invaluable competitive weapon.
And it goes beyond just getting the hardware first, right? There seems to be a deeper integration there.
Yes, absolutely. NVIDIA is a direct equity investor, holding roughly 7% of CoreWeave, and they were an anchor investor in CoreWeave's IPO. That provides a really powerful endorsement and signals a deep strategic commitment from the leading AI chip maker. Plus, there's very intensive technical collaboration between them. You see this vividly in their joint MLPerf benchmark submissions. This highlights just how meticulously CoreWeave's infrastructure is optimized to squeeze every last drop of performance out of NVIDIA hardware, which directly explain those superior MFU figures we were discussing earlier.
Okay, so that's the powerful strategic moat. But what about the gilded cage aspect? What are the inherent risks of being so singularly dependent on one, albeit dominant, supplier?
Well, the biggest risk is clearly vendor lock-in. CoreWeave's entire business model is fundamentally predicated on NVIDIA's continued technological supremacy and, just as importantly, the consistent availability of their chips. Any significant disruption to NVIDIA's supply chain, a sudden change in their pricing or allocation policies, or even if, hypothetically, NVIDIA's technological lead were to decline relative to competitors, any of that could severely impact CoreWeave's ability to operate and grow. Critics also argue, and it's a fair point, that CoreWeave's primary advantage stems largely from this privileged access to chips, rather than genuinely proprietary technology they developed entirely themselves. This could make them vulnerable if, down the line, high-end GPU supply becomes less constrained and the larger hyperscalers manage to secure similar levels of access.
And given how closely they're intertwined, supplier, investor, collaborator, IPO supporter, could there potentially be regulatory scrutiny down the line regarding fair competition or market concentration? Is that a concern?
It's a legitimate consideration, certainly. While nothing formal has been announced, that unusually close relationship could potentially raise concerns among regulators about preferential treatment, fair competition, and overall market concentration. It's definitely a tightrope walk for both companies, needing to maintain the clear benefits of the partnership while carefully navigating those optics and potential regulatory interests.
It certainly sounds like a delicate balance. Let's shift gears now to the broader competitive landscape. How does CoreWeave navigate a field with these absolute giants like AWS, Azure, and Google Cloud, while also fending off other specialized providers? It feels a bit like David versus Goliath, but maybe David has a very, very powerful sling provided by NVIDIA.
Yeah, against the hyperscalers AWS, Azure, Google Cloud, CoreWeave's specialization is really its core advantage. They argue, and the benchmarks often back this up, that their purpose-built architecture makes them significantly faster. They claim up to 35 times faster in some cases, and often much less expensive for dedicated AI workloads, sometimes quoting as much as 80% less cost. There's this ironic, almost symbiotic relationship right now where even giants like Microsoft Azure actually become CoreWeave customers because their own internal AI compute demand is just so overwhelming they can't meet it all themselves. However, as you hinted, this is unlikely to be a stable, long-term state of affairs. These hyperscalers are investing tens of billions, literally, in their own AI infrastructure. So that dynamic where they rely on CoreWeaves will inevitably shift over time.
Right, so they're helping the giants for now, almost acting as overflow capacity, but that cooperation might not last forever as the giants build out. What about the other specialized cloud providers in this sort of neo-cloud space, companies like Lambda, Crusoe, Paperspace, or RunPod? How do they stack up?
CoreWeave's principal differentiator within that group, among the specialists, is really its sheer scale. While these competitors certainly have their strengths and niches, none possess CoreWeave's massive capital base or its vast infrastructure footprint. Fueled by those multi-billion-dollar debt facilities we talked about, CoreWeave can operate at a genuine hyperscaler level when it comes to AI capacity. This allows them to win the largest, most demanding contracts, the ones that require tens of thousands of GPUs operating as a single cohesive supercomputer. That kind of capability is simply beyond the reach of most of the smaller specialized providers right now.
Scale definitely matters when you're talking about building these massive AI superclusters. So how does their pricing stack up against all these competitors, both the giants and the specialists, especially for those high-end, in-demand GPUs?
CoreWeave's pricing is generally seen as transparent and quite aggressive, especially when compared directly to the major hyperscalers. A really significant advantage they heavily promote is the absence of data transfer or egress fees. Those fees can be a huge, often unpredictable cost on platforms like AWS or Azure, especially for AI workloads that move lots of data. They also offer flexible pricing models, everything from standard on-demand rates to significant discounts up to 60% for reserve capacity, and of course, custom contracts for their largest enterprise clients.
Those numbers and comparisons can be a bit dizzying when you just hear them rattled off. Let's try to make it really clear for our listeners. What's the big takeaway here from these price comparisons? Is CoreWeave just slightly cheaper sometimes, or is there a fundamental difference in how they approach pricing that makes them a true game changer for large AI operations?
Yeah, that's a good question. The big takeaway, I think, is that for large-scale, mission-critical AI workloads, CoreWeave often presents a really compelling total cost of ownership, or TCO. Let's take an example. An 8x 8100 instance. On CoreWeave, that runs around $49 per hour on demand. Compare that to AWS at roughly $55, or Google Cloud, which can be over $58 for comparable setups. Now, while some smaller specialized providers like Lambda Labs or RunPod might offer individual GPUs at a lower headline hourly rate, say under $2 per GPU per hour, you have to remember that CoreWeave's advantage comes with their integrated, purpose-built infrastructure. It's designed to make those hundreds or thousands of GPUs work seamlessly together as a system. They offer not just individual GPUs you have to wire up yourself, but a pre-optimized supercomputing environment at scale. And critically, it comes without those hidden egress fees that can rapidly escalate costs on other platforms when you're moving massive data sets around for training. So for large users, that TCO calculation often favors CoreWeave.
This has been an absolutely incredible deep dive into CoreWeave's past and its present operations. Looking forward now, what's their strategic outlook and what are the key challenges they really face as they try to transition from this, well, meteoric rise into potentially a more mature, sustainable phase?
CoreWeave is truly at a pivotal juncture right now. Its future really depends on successfully managing that transition from pure hypergrowth to achieving sustainable, profitable operation. Their key strengths are undeniable. That unparalleled NVIDIA partnership, their proven performance and scale demonstrated in benchmarks, a significant first-mover advantage in the specialized AI cloud market, and of course their unique and proven capital-raising prowess.
But those challenges you mentioned earlier sound pretty formidable. What are the critical headwinds they'll need to navigate successfully to make that transition?
Well, the path to profitability is probably the most immediate and pressing one. They absolutely need to move from the growth at all costs mindset to generating sustainable positive free cash flow. That means managing those significant net losses and the mounting interest expenses from their substantial debt load. Then there's managing the debt burden itself. It's been a powerful engine for growth, but it's definitely a double-edged sword. Market downturns or an inability to refinance that debt on favorable terms could be catastrophic. Customer diversification is also critical. That existential reliance on Microsoft and just a few others is arguably their single greatest strategic risk right now. They simply cannot continue with that level of concentration long-term if they want stability.
And the competition is only getting fiercer, I imagine, as everyone, especially the hyperscalers, catches on to the sheer scale of the AI opportunity.
Absolutely. The hyperscalers are investing, as we said, tens of billions into their own AI infrastructure. They will likely close the hardware and performance gap over time, maybe not completely, but significantly. And that will inevitably intensify price competition in the GPU cloud market, potentially leading to commoditization. Finally, there are the fundamental physical and increasingly energy constraints. Securing enough reliable power for new, ever more power-hungry AI data centers is becoming a fundamental bottleneck for the entire industry. This could ultimately cap CoreWeave's expansion potential regardless of customer demand or funding.
So given all that, what are the core strategic imperatives for CoreWeave? What do they absolutely need to do to ensure long-term viability and truly cement their position as a pillar of the AI economy?
I think there are three core imperatives. First, they must aggressively diversify their customer base. move beyond just the largest AI labs, and make a concerted push into new enterprise verticals. Think financial services, life sciences, manufacturing, areas where specialized AI compute is becoming critical. Second, they need to continue relentlessly moving up the value stack. Build out more software and platform services exactly like the Weights and Biases acquisition demonstrated. That transforms their offering from just renting hardware into a more integrated and sticky platform as a service, or PaaS, specifically for AI developers. That's a much stronger defense against commoditization. And third, they absolutely must demonstrate prudent financial management and present a clear, credible path to profitability. This means carefully aligning their massive capital expenditures with profitable long-term contracts and showing investors and lenders a clear trajectory toward positive operating margins and eventually positive free cash flow.
CoreWeave's journey, really, from a crypto startup operating out of a garage to becoming an indispensable AI infrastructure provider, has been nothing short of astounding. They're undeniably at a high-stakes moment now, poised somewhere between solidifying their status as a true pillar in the AI economy or, as some might warn, becoming a kind of cautionary tale of, flying too close to the sun with debt-fueled growth. It really makes you think. As this AI revolution continues its exponential growth, how will the delicate and often difficult balance between rapid expansion and long-term financial sustainability ultimately reshape the entire landscape of the cloud industry itself?